Good afternoon, ladies and gentlemen. Welcome to our video studio of CFA Association Russia. We come back with our monthly macro summary with Andreas Bickel from Zurich. You've read quite a bit about him during our video countdown a few minutes ago. So I'll mostly present our moderator today, who will take the floor from me and who will present the main speaker. Let me give the floor now to Maxim Matveyev, CFA, member of the board of directors of CFA Association Russia, an investment professional with over 25 years of experience in the most active market participants in Russia, and now CEO of Atera Capital. Good evening, Maxim. The floor is yours.
Vladimir, thank you for the introduction. Since our previous webinar in the beginning of October, S&P 500 has added 7%, and overall US equity markets rally was very persistent. S&P 500 printed new all-time highs 75 times over the last 12 months. This is the highest, the second highest number since 1928. But returns for investors on some other markets were, like Russia, for example, were not so spectacular. After a heavy drop on Monday of more than 5%, the drop of RTS index over the last month was about 12%. So should investors stop worrying about the return on their capital and start worrying about the return of their capital? Let's dive into the analysis of the trends on the global financial markets. And I'm presenting our speaker today, Dr. Andreas Bickel. He has more than 25 years of experience in portfolio management as head of management at Goldman Sachs, Clarendon, and Rothschild Bank. He is CIO of Blackfort Capital. Andreas, please go ahead.
Good evening from my side, and thanks to both of you for the nice introduction. Let me try, as always, share my screen with you. Good, I hope you see this well. Should people worry about markets or about the return of their capital? The answer is, to my humble take, always yes. Especially as we speak, when I left my desk, the US market were still reddish and in a minor pullback since Mr. Powell was reappointed as Fed chair. We do see some pullback. So one thing is to say the Christmas rally, if there will be one, it was already one in October, November. 7% is a tremendous return. I believe that the climbing the wall of worry will continue, but I will tell you why in a second. As always, we make a bit of macro, high picture, inflation, what it all means, especially for returns, real returns. Where shall you invest in the bond space, if at all, and what it means for a traditional 60-40 portfolio. 60-40 in the US context means 60 equities, 40 bonds. This is a very important question, given that all asset classes are expensive. And last but not least, I might touch shortly on other areas like gold, commodities, ethics, and so forth. With that, let's dive into the latest data. The latest data for me is PMI. PMI is a soft economic data which is neglected by economists. As you know, if you follow my speeches regularly, I was quite outspoken and quite positive about the growth outlook. Basically, not mirroring what you get from economists. The reason for that is PMI were always, during that time, above 55, which is the acceleration area. And I got actually surprised yesterday when I saw the Eurozone PMI data. They have turned, although today IFO was negative in Germany and ZEW is negative, but the PMI data, so the real guys who really sell products, they tell us since 2-3 months, we are actually seeing improvements, disregarding the COVID, disregarding that there might be another lockdown in Germany. We see improvement, and most of this data is above 55. That's acceleration. This is a positive news and surprising. The UK was also released. It's a bit of mixed picture. Some data are decreasing, some are better, but all, that's important, all are still in the acceleration phase, disregarding the headlines. Two other data which were released yesterday, on one hand is Australia. I have no clue why Australia is released and there was no data from China, from this market institute. Nevertheless, Australia, if it's a proxy for Asia Pacific, you see that since 5 months, finally, they start to accelerate. They are now all above 55. The slope is positive. That's quite promising, especially if you consider that Australia exports certain products to the Asia Pacific area. Last but not least, yesterday was also the market PMI data. Normally, I neglect that, but given that there was no actual data from ISM, which we will see next week, I thought I'm including that. Also here, the data is a touch lower. It's the second month in a row, but all the data is still in the acceleration area. This, however, contradicts the latest release of the ISM Institute. ISM Services has reached a new record level of 66.7, so far above 55, far above 60. The narrative is that consumers start spending. We see strong retail demand, but the narrative is as well, we do see a strong rise in paid prices. You see that underneath, it's above 80. So inflation is definitely a problem, but on the other hand, backlog orders, the warehouses are empty, and the consumer in the service sector, but also in the manufacturing area where the data goes back to the 40s, we do see a strong demand, a strong acceleration, and inflation pressures. This is a chart from today. It's from Goldman. Goldman has, on the macro side, reduced the GDP forecast for several times in the last 4 months. However, now they had to change. And the funny thing was the comment, reflecting stronger than expected retail sales and outdoor production. I mean, as an asset allocation, I must smile. As an economist, I'm not surprised. The point is, if you were to follow PMI data and do not neglect them, like most economists do, you should not be surprised. Having said that, if Goldman is right, and we do see 5% GDP growth in Q4, that has impact on EPS, that has a positive impact on the outlook of the economy and obviously on the stock market. So I'm not surprised, at least for the US, I'm surprised for Europe, that the data gets stronger. Economists across the board, if you read newspaper research, they are surprised. Here you see the surprise globally, also from Goldman today. Again, key economic data has surprised to the upside lately. Well, we can argue about it, but let's just take the fact. We have a positive slope and more growth is expected down the road. That's the key message of this chart. That's the key message the economist had to draw. If we continue with this narrative, that's the latest release of the same data for China. Latest means at the end of last month. The next data will be released at the beginning of next week. The key message here is on the service and on the manufacturing side, twice you read strongest increase in total new work for 4 months, or strongest increase in activity and new orders since July. The PMI data itself is hovering around 50, so around the growth area, or the dividing line between growth and deceleration. But the important bit on the top is we have seen now several data points upward moving. The slope is positive. So also from that angle, on a lower level, but also from that angle, you shouldn't be surprised if we are going to see positive eco news from China beating estimates. The same holds true for ASEAN. You see that all ASEAN countries are up. Vietnam, as you probably know, we have a position in Vietnam. Vietnam is the best performing stock market year to date, at least when I screened from my Bloomberg screen. The funny bit is, until recently, the second best was not the US, it was CAC 40, so the French stock exchange index, and then followed by the US. It's a heads race. So you shouldn't be surprised that also in Asia, or at least in the Asean area of Asia, we will get positive data. And not shown here, also Japan data has surprised on this now slide in the growth area. What's the problem? Why I'm worried? Well, at the moment, latest CPI data, for instance, from Germany is at 4.5%, has never been higher since the 70s. And the producer price index already last time was at the highest level on record, but now it's increasing by more than 18%. So the inflation side from the production angle is more than 18%. There is the fear that we will see second round effect, a spiral, a positive loop, feedback loop with wages and inflation. That's going to happen, has to be seen, but as a matter of fact, you have zero interest rate at the ECB. Mrs. Lagarde, who got a new name, she's now called Madame Inflation, has clearly stated there won't be any rate hike next year. Inflation is transitory. If you follow me regularly, you know that I disagree. I would say next year we are going to see a transitory effect, so lower rates in the second half of the year, but, and that's the important bit, but at a higher level than previously. And higher level probably means above 3, maybe even above 4% for the US, and the similar figures for Europe. So sticky high inflation. Here you see the actual picture on the CPI area. Latest data was the US and Spain. So the US, including energy and food at the low percentage, but including 6.2%. Spain, due to energy prices, more than 5%. And Germany, we already had 4.5%, which for Germans is an extreme high number. What does that all mean if you look across the globe and you take the 4 major central banks and derive the real return from the government bond yield? You see that all around the globe, including Japan, adjusted for inflation, here adjusted for core CPI, so excluding food and energy, you are in a negative territory, you lose money. This you should keep in mind when we turn to the 60-40 portfolio. But the key question obviously is, what comes next? Sorry for this chart in terms of the scribbling on it. It is taken from a blog which I follow regularly. The key message is straightforward. Year-over-year figures, so November, December, January, February, they are so low that by construction, the next data releases for the US will be higher even if inflation were to be zero just because of base effects. But I would rather bet that the 6.2% I've mentioned before will be topped. And then in Q2, probably due to a statistic base effect, we might then see what the Fed tells us is transitory. Let me say that even the Fed and Madame Inflation, so the ECB, both prepare the ground to tell us that forward-looking over the coming years, inflation will be higher than the 2%, but that's okay with the new target. You know, we have now 2% with up and downside possibility. We were so much down below that threshold over the last 12 years that now there will be years where we will be above, i.e. on average, the statement might still turn out to be true in 5-10 years. Having said that, I strongly believe that the yield of government bonds and the yield of policy rate will stay below inflation. And if you follow me regularly, you do know that this is also called financial repression. Financial repression is something which you find not in most textbooks. It's something which would mean a paradigm shift. which we had after World War II, which we had after the great financial recession, the deflation phase in the 30s. Basically, you keep rates and market rates of government bonds below the inflation figure. And if you look here, the futures market prices into 25 a level up or below 2% for the 10-year treasury, and for the policy rate of the Fed at 1.6%. Goldman is a bit more upbeat on the treasury yield, but even they say we expect 2.5%. I'm almost sure that the inflation over that period will not be below 2.5%. Therefore, you see also here, you have inflation, most likely at higher level, at the moment definitely at higher levels than the yield you can achieve, be it at the short end, be it at the long end. And you might see yield curve control, which we have actually. The bond purchasing programs are controlling yield curves, or manipulating is probably the better word, because they tweak their buying to areas where they want the yields to stay at current levels or even to push them further down. What this all means, if you put it together, and that shouldn't come with a surprise because we had the chart last time, if you buy US high yield with the high long duration and you subtract the inflation data, you are ending up roughly with a negative real yield of 1.8%. Let's say for the simplicity, 2% if you buy chunk bonds. Why is that worrisome? Well, first of all, the nominal yield, the nominal inflation will be more than 2%. But just for a second, let's assume we were to see 2% over the coming 10 to 15 years. I would expect that figure to be higher, but let's just assume that for a second. In real life, we see in Switzerland, where we had over the whole period since 1929 up till now, this 2% on average. Over the whole period, that's a lifetime, over the whole period, you lose or were to lose 86% of your purchasing power. And now do the math. If it's 4% or 6%, where we are now at the moment, obviously this effect is accelerating. And there's a simple way you can calculate that. 72 divided by the inflation. So if you take 4%, it doesn't take 36 years, like stated here. It takes rather 18 years that you lose half of your purchasing power. So therefore, negative yielding assets like cash and bonds and junk bonds is a problem for your purchasing power, and you need to address that when you invest. Where shall you invest, and are Chinese and Asian corporates attractive? There is a whole seminar on that. You find that on our YouTube channel, Blackfort on YouTube. I will be quick. So when I gave the seminar, we were at this red cross at the record level. I have updated the data. In the meantime, you have seen a further spike in credit spread and now a sharp decrease. The heat map at that time was underneath the two red boxes, offshore bonds. It was showing most stress on record. Only on the onshore, there was a bit less stress. So everybody was scared to death. Nobody wanted to hold the bonds. Here you see what the market was pricing in. So the actual default rate and what at that time, before the spike, actually was pricing in how much debt will default. Huge stress. The LACMOS or ITIMOS test was and is still ongoing in November. There were and still are a lot of redemption of bonds and repayment and coupon payments. But guess what? We have seen no default. We have seen all the coupons paid, even from Evergrande. To be fair, there is still a one to follow in some days, but up till now, there was no default. Why we had so much stress? In October, there was the year-over-year figure, how much contracted sales of new flats and houses were done, and you see a tremendous drop. We will concentrate on Agile, that's a double B bond, had a drop of 27%, and also on Sunak, which also had a drop of more than 30%. You see here the blue dots, the one on the top, that is an Agile bond maturing in March, in less than 6 months, had a price of below 60 for a short period of time. And you see also the red dots of Sunak. But Agile and Sunak, here circled with red, fulfill all the 3 criteria China has imposed. If you fulfill the 3 criteria over the next years, you can increase your debt level by 15%. So they both were in the green area. So they are well financed for their rating and for their credit risk. But look what happened. Agile dropped. This bond is the one in August maturing. There was the other one I mentioned before, which dropped even more. The seminar was almost at the bottom. Since then, we have seen a strong rebound, and I would argue that most of these bonds, especially the one I show here as example, and I should stress this is not financial advice and not your financial advice. These are examples to illustrate. But I would argue that these bonds will repay at 100. This is a non-investment grade bond, so you see how much it dropped. And here you see an investment grade bond, the Sina Ocean. It was at 70 roughly. And the seminar was again where you see the red circle. However, look what happened in the meantime. We were above 90, so if you were a trader, great trade. Now we are a touch below that. But the likelihood that this bond is going to be repaid, in particularly if you compare it to Evergrande, which is still not defaulted, which has repaid all the bonds and coupons, and the share is up. This one has 54 times more cash on the balance sheet. But even so, it was traded down because the whole market was under stress. At the same time, these are all global high yield indices of the world, excluding Asia. I mean, you do not see this stress here. That's the good news. So if you were to hold, for instance, US high yield or European high yields, you were not hit by this tsunami. However, look where we are at the moment. I mean, European high yield to worst, less than 3%, US junk, 4%. The figures are from the 15th of October. We are a touch lower nowadays. And then look at the left-hand side, Asian and Chinese corporate bonds. Now the yield is probably 2% lower. Nevertheless, this is a dislocation of the market. And if you are able to do your homework to pick your individual name, this is a huge opportunity. However, at the same time, it's a huge threat. And most people I do know in this market, unless you are a fund, they have sold out, which I perfectly understand. But from a return perspective, if you are able to broadly diversify or to pick the winners, this is an opportunity of a lifetime. Similar conclusion came from Morgan Stanley. They say that the valuation is the cheapest globally, the downside risk is overdue, the default priced in is definitely not reflecting reality. Technicals in the markets are very strong. In the meantime, we have seen a mean reversion, and they were expecting more monetary easing, and I would add also fiscal stimulus is on the plan of the government. And even that has turned out to be true. In the market, they have forced the Chinese banks to prolong the loan, to reduce the rates, and the market is recovering. This is managed by the state. So therefore, this excursus, yes, Chinese, Asian corporates do offer a high return potential, but obviously with a very high risk. But now let's turn us to year-end rally, yes or no, because that's more the theme, climbing the wall of worry. Goldman has just released their new index target for next year, and they went up from 4,900, if I'm not completely wrong, to 5,100. The question is more, how is this related? How does this derive? And if you see here in the chart, we have the blue figures representing earnings, expected earnings for next year, 226. That means probably nothing to you, but here you get more flavor to it. So Goldman expects from the actual level an increase of roughly 8% to 226, and the consensus of 221. If I take the consensus, the PE ratio for this year is roughly 22.5. That's quite high. If I take the estimates for next year and the year after, we are at 20 and roughly 18.5. This looks rather reasonable given the alternative. I would not dare to say it's cheap. That is probably the wrong message. What I would add on top of it is that the expected year-end aggregated earnings for 21, be it 206 for the consensus or be it 209 from Goldman, both are up more than 45% year over year. At the beginning of the year, the estimates were roughly at 180 for the index, and then in summer we were roughly at 190. And if you remember, I even said there I would rather bet above 200, maybe 205, 207. We will see where we come out, but the point is, so far, this market is supported by forward-looking earnings. You see that here in the orange line. And if the consensus for 243 in 2023 is correct, big question mark, then you can justify even higher prices. Another reason why I'm constructive over the 3 to 6 month period is the game we see every year, the index targets. This year, different to other years, not everybody expects 5 to 15%, most of them 8%. No. We are all over the place. The lowest is at 4,400. The highest, that's not Goldman, is at 5,300. The second highest is Goldman. If people are not complacent, if strategists are not unified, and if they do not see a unified movement up, that's quite a positive sign. News flow shouldn't be a surprise to you. PMI data in the beginning showed to you that we will have most likely positive news flow, and now it's materializing. Therefore, these data surprise indices are good indicators to foresee the direction of equity markets. Equity markets have risen, although the data, the flow was negative, the news flow was negative. Now the news flow turns positive. That supports definitely the market. The question is, Xmas rally, yes or no? So if I look at this chart, and we heard it in the beginning, we have already seen a very, very strong move. And the RSI underneath is reddish, so a digestion phase is definitely needed. I would still bet that in Q1 we are higher than today, unless there is a shock which we cannot foresee. But for those of you who follow me in the Telegram, you know this chart. You can also paint this picture. The Nasdaq is at the upper end of its trading range, has corrected half of it if you follow Bollinger Bands, but you can take any measure you want. And I would argue that it was not over this morning. And as we speak, we are reddish. So hopefully we will turn in some days or 2-3% lower. Nobody knows, but short term, I'm more worried than before. Mid-term, however, I stay very constructive, especially given that there are very few alternatives. Now turning to a question which came from Maxim. Are we at the beginning of a lost decade for the 60-40 portfolio? The answer from Goldman is yes. They tell you bonds, negative real return, low nominal yield return, equities, very low real return, but some return, cash, zero. Their conclusion is to replace bonds with cash. here you see the dilemma. If you are in a multi-asset context and you stay plain vanilla cash, bonds, and equities, you have a huge problem because the four of them are expensive. I'm not disclosing who has done this, this chart in the middle, but it shows you the active manager who is getting paid to be active has everything on neutral. Why? Well, very straightforward. Cash, zero return, no duration risk, but full inflation risk. Bonds, negative real yield, duration risk, credit risk, very bad value proposition. Equities across the globe, expensive. The real return for equities normally is 5 to 8% max. At the given level, over the next 10 years, probably it will be rather 2 to 4%, and that's extremely low. We don't know where the inflation is, but if it's 4 to 6%, you can add that on the top. That's also the assumption here. The assumption is driven by the narrative of financial repression. I came across a UK strategist by the name of Russell Napier. He was for the whole period until recently, 2 years ago, to be more precise, in the camp of the deflationist and has changed to the inflationist and tells, like I keep preaching, we will see a period similar to the period in the 50s after World War II. Yield curve control, fiscal stimulus, higher inflation, nominal yields below inflation data, equity markets probably higher at the beginning and then in 3 to 5 years, big question mark. But definitely bonds and nominal assets are not the place to be. It then asks, then somebody asked the question, is the time for the 60-40 portfolio over? The answer is a kind of twofold. If you were completely free in your asset allocation, definitely you have maybe 60 equities if you stick to that narrative, but the 40 you have to replace. I would not replace it with cash, like Goldman proposes, although their conclusion for the dollar guy is probably correct. If I take inflation into consideration and the risk of bonds and I compare cash to bonds, probably you are better off with cash, although you lose money. This chart, different to the one I normally show, is showing just plain vanilla money market equities and bonds globally. And the guy who has pulled together the data came to the conclusion, when will ever be an outflow of bonds? I do not get it. Well, regulation is here at work. All institutional investors, insurance, pension funds, they are forced to invest into bonds. A lot of family office want for diversification purposes, safe investment grade bonds. Therefore, I do not expect that this demand will diminish. By the contrary, the regulation will stay and you will be forced to buy them. And then we are back to financial repression. What's really amazing is not the inflow into equities. What's for me amazing is that the cash level has risen once more over the last 2 months. This for me is a certain conundrum. So there's really cash generation across the globe in nominal terms, and this money will be deployed somewhere. Where is the question? So if Russell and myself are correct, and inflation will be somewhere between 4 and 6-ish in the US and maybe 3 to 5 in the Eurozone, you can see that bonds don't do pretty good, but equities do well on the lower end. They do a bit worse on the higher end, but as long as inflation is not above 10%, equities do okay. They are a kind of real assets because in the end you invest in companies. But you have to add other things. Real estate, commodities, not gold, not shown here, private equity, other things like I mentioned before, art, old-timers, you name it. They should most likely all over the cycle keep the value, the purchasing power. but bonds will destroy value. So will cash. However, cash has a functionality. So if you need to pay bills, if you need to invest, obviously you need cash, but all that money which is not needed should be parked somewhere where the value, the expected future value after inflation is taken into consideration, gives you a positive return. Turning quickly to areas, so commodities, one of them. Copper is since really 6 months in a sideways channel, tried already twice to break out to the upside, hasn't done it. Copper is needed, as you all know, for the green revolution, for the EVs, or for the electrical cars. Gold is also an indicator for the business cycle. I would consider that to add. There are two ways: you can add mining stocks, or you can add ETCs on copper, so products which are invested either in copper and or in futures on copper. The green energy, the green revolution, COP26, which just ended with a compromise to get over the years out of oil, gas, and coal, should put you in a positive camp. But I came across a shocking fact. 86% of the global production of electricity is done with oil, gas, and coal. Only 4% with nuclear power station, and the rest, roughly 10%, obviously, is done with wind, solar, and other alternatives. Although we have seen since 15 years investment in the wind, solar, and alternative space, they didn't manage to get a significant part of the market, of the production. Therefore, it is fair to say that nuclear power stations are, at least in most parts of the world, a part of the solution. I do know that there is a problem with the waste, but I also do know if you exclude that, there is no CO2 emission. And at least scientists tell us that if you are willing to pay the bill, you can reuse the used uranium in the nuclear power station. It is expensive, but you can use it. I came by accident across this theme. It was in August. If I look at the chart, I missed some of the rally, but although we were there already up around 50%, from there it went further up. Now we have a little correction. That's a theme midterm. It obviously goes in the commodity space. I do not show aluminium, steel, etc., but all these commodities probably will keep purchasing power. You can replace bonds in a 60-40 with that. Brent, I mean, yesterday the big news was we will use our strategic reserve to dampen the price. Having said that, the WTI futures price went up $2. Here is Brent shown. You see, since 2 days, we see a strong move up. The reason is very simple. Apart from being in winter, the OPEC is on purpose reducing, or not increasing, I should rather say, the production. So they keep the supply scarcity, that the demand keeps prices up. You see here that we have reached pre-COVID crisis of the consumption of oil, and Goldman Sachs expect that over the coming months to increase slightly. Gold is really a pain. And I thought when I was last week thinking of today's speech, finally we are above 1850. We hopefully establish there and go further up. Well, Mr. Powell was announced, and the new chairwoman, co-chairwoman was announced, and what did we see? Very strong US dollar and much higher US Treasury yields, and obviously a huge plunge in gold. I have to repeat what I've said several times. Short term, I see no catalyst, but mid-term, I still believe gold will serve as its function as a preservation of value. Dollar, I was bullish on the dollar. I wanted to say we have overcome 2 trading ranges and are now range bound. As today I was preparing the chart, we are at the upper range of the new trading range, so it has to be seen. This has 2 reasons. One is thanks to the ECB, thanks to the 3 times Mrs. Lagarde has told us we are not going to raise rates next year. We are planning to spend more. We are planning to increase fiscal stimulus. Woof. And also the announcement of Mr. Powell had a strong impact on the dollar. So let me sum that up. I believe that climbing the wall of worry, we are in the midst of it. That will continue. Short term, there is turbulences, and I do expect some weakness, some testing of the lower end. However, macro data, I see a lot of signs of reacceleration, and different to economists, I am not really surprised as an asset allocator. I do think that the Fed and the Bank of England are behind the curve. I would argue that the Fed is deliberately behind the curve as the ECB. In the Bank of England, I would say this was a very poor way of communicating and then not to increase the policy rates. Nevertheless, we have seen more than 70 rate hikes globally this year. There is more to come. Yesterday was New Zealand, who has risen rates. There's more to come, but also inflation is here to stay, and I expect that inflation will be higher than policy rates and then most government bond yields, and for the time being also then corporate yields. So negative real yielding bonds and earnings yield on dividends, that's here to stay. I'm convinced that we will see more fiscal stimulus. This has obviously a negative impact on debt to GDP, but it stimulates the economy. It creates inflation, not like the monetary stimulus we have seen since 2008, 2009. So that's here to stay. Therefore, if you were to invest in bonds, Asia, if you really have access to a great manager and or you have expertise in picking bonds, consider that. Otherwise, knowing that I lose money in a real term, I still think the risk bucket, risk return nominal yield I get roughly 4% in the US is okay-ish. I definitely would not touch cash unless I need it for purposes to do investments or transactions. And it should be crystal clear that at the moment yields will go up, maybe not as much as people expect, but therefore government bond yields and investment grade bond yields are also areas to avoid. Having said that, there are real assets in the equities you should consider. The equity market are at the moment slightly overheated, but every time we see a dip, it still looks like that people are going to jump in. There are interesting themes like copper, uranium, less thrilling but probably helpful, gold, probably energy stocks, all kind of metals, REITs, private equity, private real estate, real assets, things which grow should help you. Global small cap look still attractive, but they have moved a lot. Microchips have reached a new all-time high 2 days ago. Now we have seen a move down with the mini pullback. Last but not least, the problem here is, and that's maybe, if you take only one thing with you, then take this with you. The forthcoming years is don't lose money. It's not to maximize profit. Don't lose money. Consider the impact of inflation, diversify globally over different asset classes and avoid nominal asset classes. And last but not least, if you are new in the equity markets, and we have a lot of new investors in the equity market, if you have troubles to lose 20%, like we have seen last year in the COVID sell-off, and are not able to stand the bear market, which takes more than just 2-3 weeks, maybe 6 months, maybe 18 months, don't buy stocks. Otherwise, you are forced to buy stocks. TINA is unfortunately here to stay. If you want to have regular updates, today, for instance, I made a little case study on where to invest or how to beat the S&P, or if the Nasdaq looks expensive or not. Follow us on Telegram, Dr. Bickel knows best. With that, I'm almost spot on. The goal was 45 minutes. We had 46. I open it up for question, and thanks already a lot for listening.
Andreas, thanks a lot for the presentation. I see one of the questions in our chat, and it's exactly follows your recommendations about the exposure to commodities energy, and the question is about energy and metals companies, which seems to be not following the dynamics of the underlying commodities. The question says that, for example, FS6 is currently trading at 7% return yield, dividend plus buyback. Do you expect the valuations to catch up? Any comments on this one?
Well, that's a tricky one, because the energy oil companies are in a similar situation like the tobacco 20 years ago. Basically, they are condemned not to invest. They are condemned to follow ESG, but they are also willing to serve their shareholders. What can they do? Well, they can pay out high dividends. They can do share buybacks because the valuation is depressed. I would argue that it's too low. If it's going up, it's really hard to say. If narrative or history is any guide, probably there will be not too much PE expansion, because if I take Philip Morris, which was split up, it was for years trading at a very low multiple, but for years they kept doing a lot of transactions, giving the shareholder value back through dividends and buyback programs. And that is definitely a theme here to stay. If you don't have to follow ESG, it is an area which looks interesting. There was, until recently, in your market, so the Russian market was supported by that, but there are global players as well, be it in Europe, be it in America, which to me, they look attractive from a valuation point of view, and they will do everything to keep shareholders happy, knowing that they are forbidden to do investments and new exploring of oil fields, etc., etc. And even there are exceptions to the rule. I'm not so sure that, for instance, the actual or the new Brazilian president will really tell Petrobras not to explore the gas in front of the bay they have.
Thank you for the answer. Please come up with further questions. I will then ask one of my own. That's about inflation, because it seems to be one of the major theme following last year. The major theme was the pandemic. Now it seems to be shifting more to post-pandemic world and inflation. So what you would, for your, like, in your investments advices, what do you consider as the major threat from inflation? Whether it will be that it will be anchored at a higher level going forward, or maybe that the Fed, feeling that it is falling behind the curve, will act some unexpectedly, and the market will not be prepared to some major moves from the Fed or ECB, for that matter. What's your major concern with regards to inflation in general?
I mean, the biggest fear is that we get the Weimar Republic hyperinflation back, like there are signs in Turkey. That would mean that the Fed and the ECB and others would really lose control. I personally do not expect that. If, I repeat myself, if Russell is right, Russell Napier, they will somehow manage that the inflation will be sticky between 4 and 6% in the US. And if you listen between the lines of Mrs. Yellen, not in the Fed, and Mr. Powell, there seems a kind of mutual hidden agenda agreement that we want to have inflation. This solves our debt to GDP problem, but it should be in a contained way. And the Fed has at least a proven track record of reacting if it gets out of control, 82, Mr. Volcker as an example. But also they have a track record that they can handle that, like in the 50s or in the 30s, although there, to be fair, the Fed had a different role or not the same tool set and mindset on the top. So the biggest fear is that we get hyperinflation. At the moment, from the countries I have in my mind, I see the risk in Turkey. As you all know, Mr. Erdogan has ensured that the central bank has decreased once more rates, although inflation goes through the roof and the currency tanks. But assuming, hoping that the major ones have this thing under control, I do believe that the most likely outcome is that we have a sticky high inflation over the coming years. So far, officially, this was never announced, but this is on purpose, this is deliberately. And to use Russell's word, although I said that before, but he has it much better, it's the hidden agenda to steal money from the private people, from the elderly, and to give it to the debtors. And the biggest debtor is the government, full stop. Of course, you will never read that in a newspaper. And let me also add, financial repression is a narrative you find not in textbooks, is not taught. And if you believe in that, also quoting again Russell, everything you learn at the CFA is worthless, because then you have to do things I told you in this presentation. And for all the younger guys, don't write it on your exam. You have to pass the exam, write what it's written in the textbook. But when you run money, at least consider the risk of high inflation and what that means to purchasing power and to nominal assets.
Yeah, absolutely. It's a real world. Yeah, we have another question from Alexander. Would you like to voice it over, or just I'll read it loud? So the CPI is likely to be higher in the following months due to the low base effect. But is it reasonable to expect CPI prints to be lower due to the high base effect starting from May?
This is a very smart question, and the answer is very hard, as the person who asked it probably knows. I mean, what do we know? What will be in 6 months' time driving inflation? At the moment, the narrative is it's bottlenecks, delivery chain, which are disrupted. It's the strong demand from retail sales. And then the people keep on telling you, but this will all solve because COVID will be over, which is probably true. However, it will take time. So therefore, my humble take is that the headline figures we will read over the next, let's say, 3 to 6 months is probably trending up. This will be extremely painful for Germany because 4.5 is already an outcry. And if that goes to 5 or so, good luck. But then my hope is that it will somehow slightly decrease to levels a bit below where we are now, hopefully. But to be honest, nobody in the central banks, no expert can really know that. But that's my assessment, my working assumption, how I run money. What we do know is the chart I showed with the base effect for the US. And then you have always to see US is not Europe and Europe is not Germany. Spain is higher than Germany, etc., etc. So it's not so straightforward. But as a general statement, in particular, more stressing on the US, I would expect this 6.2% to be topped, then to decrease. Where exactly, I do not know, but I do hope that the narrative of Russell and my assumption is right, that we will end up somewhere 4 to 6% over the next, let's say, 24 months. But honestly, nobody can know that. But that's my working assumption.
Yeah, I guess we have to admit that, all assumptions can change quite rapidly, especially with some unknown external effects, and if there will be some multiplying effects from Turkey or from other parts of the world. Can we switch on the microphone for Ivan Ilyushin so that he can ask his question? Ivan, please go ahead.
Yeah, hi Andreas, hi everyone. Yes, Andreas, you mentioned you see a big opportunity in Chinese high yield. What do you think about Chinese equities? Do you see the same opportunity, or maybe Chinese equities have to correct further to reflect current credit fundamentals, level of credit spreads? What do you think?
That's a good question. And the answer is, as always, it depends. But let me be a bit more concrete. So if you have seen Alibaba, the ADR, or JD.com, to give two names, examples, not recommendations, you see one is up, one is still in the spotlight in the government and is down. So if we are talking of ADRs, I would expect them to go up over the coming months. However, there are political situations, they are on the radar screen, they are quoted in the New York Stock Exchange, and most of them also either in Hong Kong or in China mainland. But having said that, I see tremendous opportunity in China small cap, in A shares. But normally as an investor from the West, if I can call us that way, it is hard to impossible to buy directly. That's why you buy the ADRs. However, there are funds, managers, and even some ETFs who tackle the Asian market. And the Chinese market is, I would say, reasonably priced to slightly cheap. Depends on before I compare it. And the outlook is not so bleak like they tell us. And I would still expect that the Chinese government does everything that the real estate market, which is roughly 30% of the Chinese economy, is not going to collapse, because otherwise there would be riots. A lot of people would lose all their savings. Therefore, yes, I do expect Chinese equities to do well. If it's in 3 months' time, in 12 months' time, 24 months' time, that's the big question mark. Because emerging markets have a lot of headwinds, stronger dollar, higher yield of the US Treasury, but they are cheap across the globe. And the short answer is yes.
Good, thank you. On this positive note, I suggest we conclude the meeting. It was already, we are already about an hour in this discussion. I believe it was quite useful. It was really interesting for me on a few points for myself. Andreas, thank you. Thank you for the presentation.
Thanks a lot for having me.
Yeah, at this point, we conclude the meeting, and yeah, we'll be waiting for the next webinars. Please follow the CFA website for announcements. Thank you all.